We all know that the standard trailing price-to-earnings ratio is a flawed metric for growth stocks. In a market driven entirely by forward expectations, looking backward just tells you where a company has been, not where it is headed. But completely ignoring multiples is not the right answer either. The real challenge, in my opinion, is finding a precise way to normalize high valuations against future growths. And today, I am breaking down that exact forward-looking framework that I use to filter out market noise as well as calculate a true relative value. To do this efficiently, you do not need an expensive institutional terminal. I run this entire workflow using several tools that are free of charge. I use Yahoo Finance for rapid high-level data pulling. For mapping out deeper structural financials as well as advanced modeling, I would then shift to Fiscal AI or occasionally Seeking Alpha. And here is how these data points connect. My starting baseline is always the forward price to earnings. It is measured by dividing the current stock price by next year's estimated earnings per share. And that way, the baseline is already aligned with the immediate future. But forward price to earnings in isolation is still deceptive, I have found. A company trading at a forward multiple of, let's say, 45 is not necessarily more expensive than one trading at 15, if, for example, its compounding growth runway is significantly steeper. To solve this math problem, we then have to introduce a metric that actively penalizes stagnation and rewards acceleration. That metric is the PEG ratio, the price to earnings to growth ratio. By dividing the forward price to earnings by the expected earnings growth rate, projected by analysts by the way, we then normalize valuation against momentum of growth. Suddenly, a high forward multiple becomes completely justified if the underlying growth rate backs it up. This allows us to mathematically compare a hypergrowth tech stock directly against a slow-moving legacy business and basically see who is actually offering a better risk-to-reward profile per unit of growth. But a framework is only as good as its execution in a volatile market. Theories do look great on paper, but the real alpha is found when you stress test these numbers against the real corporate balance sheets. And that is exactly what I will be doing next. In the next few videos, I will be running this exact forward-looking PEG calculation on specific companies to see if the market is mispricing its growth runway.